Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 28th of October. I'm Daniel Lam, your host for the podcast. US equities have been performing almost in perfection for this year. Almost. The only blip that we've seen so far was the episode of the global risky asset sell-off in the earlier part of August. Now, it is worth remembering that besides the weakness in US macro data around that time, the key trigger point came from a hawkish Bank of Japan, leading to aggressive unwinding of the dollar-yen carry trade and i.e. short covering in yen. Now, much of this short yen position was used to finance for purchasing of risky assets, including that of US equities, especially the high growth stocks, and therefore there was much forced technical unwind of long US equities position. In fact, a sustained unwind of dollar-yen carry trade positions represents a significant risk to US equities. Japan's real policy interest rate is currently at negative 2.3%, and Japan's real policy interest rate differential versus the US stands at an even more extreme level at negative 5.4%. And since 2022, Japan's real policy interest rate differential versus the US has dropped by 12%. From the second half of 2022, valuations of US technology stocks moved in an almost perfect negative correlation with the yen, i.e. US technology stocks moving higher while the yen weakened. Now, this relationship between tech stock valuations and the yen happened precisely as Japanese real rates went deeply negative, both absolutely and relatively to US real rates. So this is good evidence that borrowing in yen at deeply negative real rates has fueled the latest inflation in US technology valuations. So, how is dollar yen looking right now? Well, it broke above 150 recently as US dollar has been strengthening. Bank of Japan Governor Ueda noted that it was still taking time to sustainably achieve its 2% inflation target, signaling that the central bank is likely to be moving carefully in pushing up the country's still near zero interest rates. However, he also warned that the cost of moving too slowly in raising rates could offer speculators an excuse to trigger an unwelcome yen slide that pushes up import cost. Now, at the same time, dollar yen is trading in overbought territory and seems to be overstretched, likely limiting further upside potential for the pair near term. So a gauge that measures the dollar yen move from the lowest level since in the last 28 days rose to 11.5, close to a range high and not far from levels where the BOJ historically considered intervention. We see risk tilted to the downside, especially if a BOJ intervention leads to an unwind of the yen carry trade in the near term. Now, if that were to be the case, and if we do see somewhat muted earnings or guidance from the upcoming US technology companies' earnings report, and if there were to be some volatility from the elections, then we could see volatility ahead in US growth stocks in the near term. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.